Hello, everyone. Welcome back to another episode of the Delphi Pod. This is the fourth one we've released now. Obviously, we did gaming, markets, and infra, which was released the day we're recording this, which is Wednesday, December 18th. This is the DeFi one. I'm here with the DeFi team. I've got Jordan, Neil, and Robbie. They released this report last night, and so we're kind of just go ahead and dive in pretty quick. As a reminder, like all these reports, you can get everything on the portal. Definitely check them out. I think you can get like a 1 month membership or something, trial, which you can get like all the reports for. They're all like 1.5, 2 hour reads. So when you have downtime over the holidays, definitely a good time to check them out. And we're not going to get through everything on this report. The DeFi team here, they came with a few themes. The first one was consumer DeFi, almost here. This is mostly like spending cards and, using crypto actually in the real world. ZKTLS, some cool experiments there going on. We've got some stablecoin stuff, fatter wallets, fat wallet thesis. Then we've got some digging into kind of the innovation in DEX designs that we've seen, which I would say, Uniswap v4 and Sorella, probably the ones at the forefront there. But where I want to start this is kind of with Jordan. So you wrote here about consumer DeFi is almost here. I think this is a big topic, a big thing that crypto needs to get past this like niche internet thing to people using it in the real world. I also like how you kind of compared all these crypto cards and then went through like the Gen 0 ones, which are fully custodial, and then more progressing to like true like crypto native, crypto rails, like spending in the real life. So maybe like walk us through this consumer DeFi is almost here is all about.
Yeah, so I'm really excited about this. I feel like a lot of us that have been in DeFi for like several years now, this is one of the things that we were hoping to see one day. And like, I'm sure we all have a lot of ideas of things we'd like to see like with our personal finances, like when we really get to this point of using crypto in everyday life and, paying out of a non-custodial like stablecoin wallet, for example. And up until now, like a lot of these solutions that we have are very clunky and like they just don't really work well. And if you are one of those people that's trying to like maximize the amount of like your personal finances that are in crypto, it's more of just like a party trick or just doing it to say you're doing it. And it really looks like next year this is going to be viable, definitely for crypto natives, and then maybe if we're lucky, like it'll start to be good for like normal people that have no interest in crypto. And the reason why I think that's possible is because once this UX gets good enough to where like, okay, you couldn't just have a direct deposit into a crypto wallet and then pay both for like everyday spending and your bills. I think that with building this with different DeFi applications, it'll be too good to like not do compared to like a savings account where you make like 0.5% in APR. So I'm like really excited to see one, like the basic architecture of this continue to get built out. And then as well, like once that does, seeing what people build on top. And so like, yeah, like right now, the only two main, like cards that really get used a lot that are live are Holly Held and Gnosis Pay. There's a lot more. There's a ton of cards, but like these are the ones that have a lot of traction. And seem to like have the most mind share and like discussion around. And Holly Held does really good because it's like it completely streamlines the sort of top up process that a lot of these prepaid cards have. So you can sort of you can connect any wallet on any chain basically, and it accepts like over 1,000 different tokens. So you can just sort of do your daily life with DeFi, and then it'll take like under a minute, and it's gasless to just top up this card, and then you can use it.
So I think the difference between this one and some of the other ones you've talked about is this is still like goes into that Gen 0 bucket where it's fully custodial. You have to like move money over. You're kind of just like prepaying a card. But you've had some of these, maybe let's go into like some of the more end game type designs that are out there, because I think these ones, they're more so like you keep all your assets in your wallet, right? And then when you actually want to spend it, then it kind of does the conversion in the back end and everything. So maybe we can touch on those.
Pay, I think are like very comparable, right? Because they Fuse sits on Solana, and Gnosis Pay sits on Gnosis. And other than Ethereum and Bitcoin, these are probably like the two most decentralized blockchains out there. So you sort of get best practices as far as like non-custodial wallet, like you have your keys and then you're on a decentralized blockchain. You're not on some like L2 that like has a multi-sig or something. So it's truly like completely represents the ethos of like self-custodial finance in that regard. And then, but these don't quite have all of the training wheels off as far as like what you're able to do. They have these sort of multi-sig smart accounts, and you sort of still have to top that up like you do with the prepaid card, but these are still like legitimate debit cards. And then and like you're seeing right now with Gnosis Pay, they have Zeal, which is a smart wallet that sits on top of it, and that'll automate the top ups for you. So you're still sort of getting that DeFi experience, whereas you're not on these ones where you have to manually go through and do it. Another distinction here is that you're using crypto tokens on these. So like on Holly Held and some of these Gen Zero ones, you're like off ramping fiat every time. So there's not really like much of a benefit there other than just sending it back to an exchange. Whereas like on Gnosis Pay, you can sit in like SDAI and then have it top up with like EURE automatically and then pay with that. So it's a little, and then like once you get more stuff built on top, then you can just retain your exposure to crypto throughout the entire process. But then you have like Argent and MetaMask, which are two that I'm like really excited about. MetaMask is slowly rolling out in like some Latin American countries right now, and there's like videos of it on Twitter. And then Argent is not out yet, but these fully sort of remove that smart account stuff. So obviously there's a little bit more of a security risk there because the like card partner that you're trusting with the spending limit, like you're trusting them with a greater surface area of your portfolio if something goes wrong. But that'll truly allow you to like interface with an Aave. Like say you could make a payment and then draw debt against an Aave CDP, and that's where this sort of design space for building around crypto finance really explodes and gets into some really interesting stuff.
Wait, how would it do that in like the moment? Like, would you have to actually create the CDP like beforehand, and then you could like tailor it to automatically just take debt to like pay?
Yeah, you would have to create the CDP beforehand, and then you would just have to like build it to where like it's spending USDC and like taking it out of Aave. I know, like, again, I'm not technical enough to like completely answer your question, but I've talked to some of the teams that are building these. I talked to the Argent team, and then I know in the Gnosis Pay YouTube, when they announced that, he alluded to like that's something that they're going to eventually allow you to do. And again, now, like with Gnosis Pay, again, like it has this sort of like smart account carve out, and that has a delay module. So for now, like that prevents you from like, going on Uniswap and like aping a meme coin right before you spend money. But like there's no technical reason why like that's not possible on Gnosis Pay and Fuse Pay. Like eventually that's just like sort of a way that they're constructing their platform right now. But yeah, again, out of the gate on Argent and MetaMask, like that's something that is possible to build, for example. I find that really exciting. And just the amount of like, I mentioned like you could have an Acorns Grow, which if you're not familiar, that's this like financial app that like lets you round up what you're spending at the cash register and then put it in like stocks. It's like a Tesla stock. So you could do that. You could build that in crypto to where like you go to Target, you round up your money, and then that goes into like a pump fund launch or something. Like there's all kinds of like random stuff. Once we really like realize the extent to which like we can play with money on chain, I think it's going to blow a lot of people's minds the same way that like Alchemix and Yearn Finance did last cycle. Like people are really going to get mind blown by DeFi, and like that's going to be a big moment for us as a community.
Yeah, I definitely think the biggest area that DeFi can like, I think most things, there's a lot of stuff in DeFi, like money markets, DEXs, that are seeing some marginal improvements and stuff, but the core of, DeFi is kind of infra in a sense too. The core of like DeFi infra is probably built, but I agree on the consumer front, it's always been lacking pretty hard. And so yeah, being able to like completely distance detether from having like a bank account and stuff and actually just having all your assets on chain is definitely becoming more of a reality, which I agree, it's definitely exciting, probably the most exciting part on like consumer finance right now. And it's something that like fintech can't really to the extent that like crypto's doing, right? And so like that's where the big unlock kind of comes from. Yeah, so I agree that's like a big theme for next year. I'm excited to see kind of like how these pan out. Actually, let's go to, I'm going to switch it up a bit. Let's go to the stable coins. Robbie, I know you've been like basically just like been writing about stable coins for feels like the past 2-3 months or something. You've dug into all this a lot. And I think kind of like the big theme there is kind of with like a lot of these new like stablecoin 2.0s, right? Which actually have these new models, which are actually shifting some of the revenue back from, you know, like Tether owning it all to being distributed further. So maybe just take us through like stablecoins and like what you're seeing there.
Yeah, for sure. Well, I think, yeah, stepping back maybe for a second, you know, we always hear that stablecoins are kind of crypto's killer use case. I think like that take alone is sort of reductive. And I think you kind of have to split stablecoins into, you know, two use cases. One is what I would describe as kind of oiling the cogs of, you know, crypto's speculative kind of casino. And then two is like actually serving as like a monetary asset, right? That people, you know, whether that's, you know, in emerging markets getting access to US dollars, or if that's like actually making payments. And I think what's really interesting about this past year and what I think's kind of going to play out in 2025 is you're increasingly finding that stablecoins are finding product market fit with that latter use case. So there was a chart I think I shared in the year ahead report that kind of shows that active addresses actually sending stablecoins has gone absolutely up and to the right, irrespective of kind of where trading volume has been. So I think that's really, really important to note. And I think it's not something that the market's kind of realized yet. I would say kind of the second thing is you're starting to see fintechs actually adopt stablecoins. And the way I would frame this, and this is kind of why I think this adoption is inevitable, and like the game theory would kind of imply that eventually it kind of becomes table stakes for these fintechs to adopt stablecoins. And the reason is like fundamentally they can improve the bottom line of these fintechs. And that's kind of done in a number of ways, whether that's, you know, doing payments, especially kind of in the global context, or if that's allowing existing fintechs to kind of own more of the payment stack. Like Stripe, for example, I think the Bridge acquisition's kind of been conceptualized as, you know, well, Stripe kind of just wants to expand into global payments. I think it's kind of a broader strategic move to eventually own more of the payment stack by kind of creating their own closed loop network with stablecoins. So I think you're going to start seeing a lot more fintechs in 2025 kind of explore stablecoins. I think Visa is a great example. Like stablecoins explicitly kind of cannibalize their own margins, yet they're still exploring it. So I think that kind of signals that, you know, this is something even they're paying attention to, because I think they're kind of at risk of getting disrupted if they don't pay attention to it, right? So that's kind of like in a macro view why I think stablecoins are really interesting at this point. You know, it kind of begs the question, well, who's going to ultimately benefit from this kind of broader trend? Intuitively, you would think Tether, right? And I think that probably will be the case. Tether and Circle, more specifically Tether, just given this is kind of inherently winner-take-all game at scale. It's kind of stablecoin market. However, there is an emerging model that I think is at least well-positioned to kind of disrupt the existing model. So these are what I'm calling kind of stablecoin 2.0s. You could even call them 3.0s to some degree, because prior to this, we had yield-bearing stablecoins, and that was kind of a very hot topic for a while. This is the idea that you basically just hold this stablecoin and you kind of get paid yield. I kind of see two problems with that. One, on a regulatory side of things, like that's technically a security. So that's why it's been kind of hard to push adoption of these. But then two, and I think this is probably more important, is they're trying to first win over kind of the end user. And I think the smarter way of playing this is to ultimately focus on who actually owns distribution, right? And that's kind of the applications themselves. So if we kind of split up, unpack kind of what the existing stablecoin stack looks like. In terms of how value is captured, you have the applications which capture none of the value that they create on behalf of the issuers. And then you have the issuers who are very kind of fat in the value accrual stack, right? They end up capturing all this value. And I think it's kind of a paradox because it's actually the applications that give USDT its utility, and they're the ones actually bringing supply to the network. So they're actually the ones creating all of this value for Tether, right? So this is where kind of revenue-based stablecoins, revenue-sharing stablecoins flip this existing kind of stablecoin stack on its head by basically saying, look, if you bring supply to our network, we'll give you yield according to the amount of supply you bring to the network. So there's kind of three examples of this. So one is Paxos USDG. So this is not yet live, but they have announced it. I think their partners like Robinhood, I think Kraken's a partner, and then they have a bunch of market makers. The idea is basically, you know, these exchanges who again own distribution can kind of push users to actually use USDG, given they have an incentive to do so, given they get economics from that, right? So I think that gives it, puts it in a much better position to at least disrupt Tether if they're going to whoever has distribution, right? M0 is another one. They're kind of, it's a little bit different in the sense that if you want to integrate M0, you could be either a minter, meaning you actually mint M0, or you could be a integrator. So you just kind of integrate. M is their stablecoin. And then it's also seen as kind of like this raw material for other stablecoins. So Noble, who's kind of a stablecoin project in the Cosmos ecosystem, built their own stablecoin now on top of M. And then there's Agora, which is kind of doing the same thing as USDG. Anyone who kind of has supply, brings supply to the network, gets economics in this. So I think this is like a fundamental kind of shift in how stablecoin issuers operate, in that it kind of democratizes access to the economics historically only enjoyed by Tether and Circle, and gives it not to the end user, but to the applications who actually own distribution. And then if they want to give it to the end user, they can. If they want to keep it for themselves, they can. And I think the last thing I would just add on this is this could also be a fundamental shift in how sort of DeFi projects actually make money. I think we're going to increasingly see margins kind of compressed throughout DeFi. This has kind of always been a thesis I've had that, when everything can be forked and subsidized, it's very hard to kind of build out a moat. And therefore margins may compress. But I think we could end up seeing kind of the business model of a lot of these projects kind of evolve into this, almost like selling stablecoin distribution as a service, where the majority of the money they make is actually by being a part of these networks, bringing supply to the network, and you're basically compensated according to the amount of supply you bring to the network. And I think intuitively this actually makes sense. And I shared a chart in the year ahead report where it kind of showed how value has been created kind of within the crypto economy. And right now it's actually stablecoin issuers have generated more revenue than blockchains and applications combined. And that's not just one, that's every blockchain application. So this would imply that maybe the value to be captured is actually at the stablecoin layer. And therefore, by giving projects stablecoin economics, that could be kind of their main business model.
Yeah, it's hard to tell like where you can actually like skim off fee income and revenue as a DeFi protocol, especially when the end of the day, these are just like contracts that you can like fork and everything. But stablecoins always have this fundamental value driver. And yeah, if you create like a good app, you work with these like new stablecoins to kind of get them integrated to your platform, then you might not even make any money off of like the actual app that you've built, but you're kind of just making off of the fact that you have like this revenue share with the stablecoin. That's an interesting.
Yeah, if you just play that logic out too, like if I can now make money as an application basically off this stablecoin yield, well, now I can drop my take rate, right, to basically zero. And now everyone else kind of has to do that to remain competitive, right? So game theory in that context would imply that, everyone kind of has to do this eventually.
Yeah, no, that's a good point. And I don't think we've totally seen that yet. All these stablecoins are like pretty new. It is still hard to see Tether being disrupted as like the main stable. Obviously, Athena, which is, we'll call it like synthetic dollar, has done pretty well with yields being really high recently. I think another one, I don't know if you've looked into it, Usual has done decent recently. They had some pretty big incentives in their token. I think like you hold the stable coin, you get their token, but then the token is what's going to get like the actual yield from the underlying underneath, which that doesn't, I guess, go into the same kind of spot as the other ones where like the application is getting it. This is more like the holders of the token, I guess. But yeah, I was surprised that the Usual has actually, I guess the incentives are good, but like they've actually been able to bootstrap pretty well versus other newer stable coins that have found it a bit more challenging. So I think, yeah, the market for stablecoins is obviously massive. We talk about this all the time, but I do think these kickback mechanisms are, if you're going to disrupt it, this is kind of the way to do it. Like being totally integrated with the apps like that makes a lot of sense. Yeah,
so one thing I would just add to is I think this becomes especially relevant in a world where fintechs are ultimately ushering in kind of the next wave of stablecoin adoption, where they're going to, obviously they're going to demand economics on the sort of supply they're bringing to the network, right? And with this model, if you're doing it across a network, you have composability across. Like if I'm a fintech right now and I want to launch my own stablecoin, I can do that, but my stablecoin is not going to have utility in other kind of ecosystems, right? But if I do this with a shared network, now my stablecoin is composable with the same stablecoin on all these other networks who are also incentivized to adopt it. So I think that's kind of the key in understanding why this model could be so effective at scale.
That's good. Definitely will be a big year for stables again. And yeah, I think that straight back acquisition kind of like, I don't know what the term I'm looking for, not nail in the coffin, but like kind of really put that trend into like full speed. I think next I kind of want to talk about, we have in here 2025 year of the DEX Accelerate, right? That ACC meme. It's been a year and a half now since people have been talking about LVR resistant DEXs and this like big innovation in DEX design. You know, everyone still uses kind of like Uni V2, V3 style DEXs, but I know like Sorella Labs and Uni V4 are coming to market soon. So maybe we can dive into that, Neil, and talk about like why you think DEXs, who have been pretty, there hasn't been a lot of innovation DEXs recently, and like why you think like 2025 is going to be the year that we finally see like a lot come out there.
Yeah. I think one major reason why we don't see a lot of innovation in DEXs is because it's just too hard to bootstrap liquidity and get users. You may just be able to build out the best DEX which exists out there right now, but you don't have the kind of distribution that Radium does or someone like Uniswap does. So in any case, getting adoption for your new DEX has always been harder. And I think like with Uni V4, that is the one major thing that is going to change up. If you have a great DEX design idea, you can go and build it and just tap into the liquidity, order flow, and the users that these platforms have already built over the last 3 to 4 years. So I think that is going to be the biggest unlock. Any dev who has like a good enough idea, or any team, like we have the Arrakis team, Bunny team, or the Sorella team, all of these teams that have their own unique ideas on how we can tackle LVR or get back as much value to the LPs as possible. They can just spin out their idea as a hook and tap into the distribution, which has been missing up until now. So anyone who wanted to kind of experiment or like try out their hand with their own ideas, they have this design space now with Uniswap V4 hooks that allows them to bring all of these users to their platform. And I think like as of now, I've just been scouring through the Uniswap ecosystem or V4 hook ecosystem for a really long time. And Sorella's solution is something that I really like as well. It's a really cleverly designed solution. They've taken a bunch of really cool ideas from like mechanism design. So they designed like a leaderless first price auction. They've designed like patch auction, and combining all of these different parts, they're able to kind of design their own network, which is where they're bundling transactions in a way that you have a uniform clearing price that allows like to kind of.
So I think maybe we'll I'm just going to explain LVR for the audience. So basically the way DEXs work today is, you know, there's a pool, and let's just say Uni V2, where it's like you put two assets in it and both their prices kind of go to infinity and they all trade on this curve. And then price discovery normally happens off chain, like a centralized exchange or something. So let's say ETH is 3K on chain and 3K on Coinbase, right? And then on Coinbase, it goes from 3K to 3.1K. Well, the pools on chain, they haven't updated their prices yet, right? And so basically the arbitrager can buy from the pool on chain at 3K, sell it on the centralized exchange at 3.1K, right? And so this is a massive source of loss for LPs in crypto. And so like when this loss versus rebalancing, LVR, this is what we kind of mean by this. This is what these Uni V4 protocols and like Sorella Labs are trying to kind of solve, is minimizing that gap between the arbitrage of like the off-chain to the on-chain. And so I think, Neil, you were saying with like Sorella, they have this first price auction. What that kind of means is like when that arbitrage is there, that $100 free money, essentially, if you want to be the one that arbitrages that pool, you have to go through like Sorella's network, right? And you have to win this auction within... Yep. And so you're trying to get that $100, most of it paid to LPs at the end of the day, right?
Yeah. The idea is very simple, right? Like with Sorella, let's say this $100 opportunity is out there, and more the solver competition or like a searcher competition exists. The idea is that people will be bidding up to $99.9 to capture this value. So initially, for the right to arbitrage the very first transaction in the pool, let's say within a 12-second Ethereum pool, this opportunity has arisen, right? So only one person can capture this opportunity, and Sorella basically is auctioning off this opportunity. And if the competition is large enough, the idea is that someone will build up most of the value that they can be capturing. So that is like the step one that is kind of followed in Sorella's design. Second design is that they're allowing users to play limit orders as well. Whenever you're trading in an AMM, what you're basically placing is market orders. But in Sorella's design, that is not the case. Users are placing limit orders, and interestingly, they're placing limit orders on the other side of the book. So the user bits are going to be on the opposite side of the order book. So you're basically buying at a slightly higher price or placing your bid at a slightly higher price. And anyone who wants to sell tokens is placing their orders at a slightly lower price. And they're doing this so that they can get the best execution, or they can get the immediate execution in this case. And the next step follows, where what Sorella's AMM does is that instead of matching user orders with one or each other, it basically calculates a uniform clearing price. Basically all the benefits that we've gotten from a lot of these cow swap auctions as well. So when you have a uniform clearing price, it is hard to sandwich transactions or extract the value through ordering in a way. So if you eliminate the ordering arbitrage, and if you take in a lot of this LVR value, which you're passing back to the LPs via the first price option that you're doing, you can capture a lot of value. And the Sorella team is pretty confident that the value capture that they're able to do is better than other DEXs. And hence the pools that they'll be launching will be taking like a 3 basis points fee as compared to like 5 basis points fees, which other pools on Uniswap are catering towards right now.
So that was interesting. I didn't realize the limit order thing they're doing. So the idea there is basically, obviously, if you were to just swap through the pool, the first price you paid would be lower. Eventually, you'd probably have a higher effective price, right? So this kind of feels like it's targeted towards people who want to do larger buys and sells, and they can kind of just sit those like resting limit orders on chain. Is that like the target audience for like bigger trades?
I don't think it's geared towards bigger trades per se, but it is focused towards any trader that wants to execute their trades on chain through an AMM. But uniquely enough, they've given like a feature for market makers to participate in this ecosystem as well. Let's say like the user orders which are coming in are to buy, let's say, $10,000 worth of liquidity, whereas sell orders are potentially just $1,000 of liquidity. So in that case, what they allow market makers to do is market makers can also place additional limit orders around the order book. So instead of kind of going way along the bonding curve of the AMM, the orders can be filled against market maker liquidity as well. So they still get like lower slippage as compared to a simpler AMM. So anyone who wants to kind of execute larger orders, yes, you'll be tapping into AMM liquidity and market maker liquidity. So yeah, if anyone wants to do larger transactions, this is still going to be the most efficient AMM to tap into.
Okay. So how does Sorella then differ from UniV4? Because Sorella is what? It's more like targeted. Sorella Labs is building all the infrastructure, and then UniV4, is it more like open for other people to build on top? Is that it? Or is there something else? Because they're kind of trying to solve the same problem, right?
Yeah, I think with UniV4, it's basically a platform for developers to experiment around. Sorella is definitely more interesting, and they've taken the problem of LVR and potentially users getting front run and sandwich. These are like the major issues that they wanted to tackle. What we're seeing in the hook ecosystem is that people are going beyond solving this as well. Some hooks are being targeted towards just providing better incentives to active LPs. Some hooks are like just trying to gamify. And interestingly, like not all of the hooks are geared towards making swaps better. There is teams like Tenor Finance, which is trying to build a lending order book on top of Uniswap v4 instead of like just a swap application. A lot of hooks will be geared towards having NFT swapping happening via an AMM. We're going to be seeing like options exchanges being built on top of Uniswap v4 using hooks. We're already have seen a couple of teams build perp AMMs, so you can trade perpetual on the AMM itself. So I don't think Uniswap v4 is targeted towards the LVR problem. That is a problem that Sorella decided that they want to tackle. And their solution is geared towards that. But with v4, I think like the design space is really huge.
Yeah, that makes sense. Do we know when UniV4 is like going live? All these things are on testnet?
Yes. So all of these hooks which have been developed up until now have been on testnet. I think Uniswap v4 was supposed to be live even now, but it hasn't been. Supposed to be early December. I think last month they were also holding like a bunch of different competitions to just mine a particular address for the core contracts of UniV4. And I think that the contest has wrapped up as well. So hopefully we see Uniswap V4 launch before the end of this year or early next year would be my best guess.
So basically on the DEX side, we have Sorella. They're trying to solve this like LVR thing, very targeted. Kind of like the biggest problem with DEXs today. UniV4, it's adding all these interesting, it's like this platform anyone can build on. What are kind of like some of the most, because I know you have some other ones in here. You've got, obviously you talked about Angstrom, that's Sorella's product. I know you've got like Bunny V2, this Doppler thing. Then you talk about Volantis, Arrakis. Like, what are some of the other DEX designs that you think are like interesting and like unique that you're like paying attention to next year?
One DEX design that I think is going to increase or going to show up a lot more on our timelines is going to be the Fluid DEX, which is being built by the InstantApp team. I don't think like they've innovated a lot in like liquidity management or things of that sort, but they've made a major DeFi unlock, which is they're using a lot of betting liquidity. So Fluid initially was a lending protocol. And a major problem for all lending protocols is to kind of find out where they're able to generate demand for people borrowing the assets in their markets. So Fluid, basically the Fluid DEX is a borrow demand generator for the Fluid lending markets. What they're doing is you can borrow assets from the lending market and now deploy them into the Fluid DEX. And they're allowing you to recollateralize the LP position that you have in the AMM plus the debt that you've deployed as an LP position is also something that you can use as collateral. So the amount of leverage that you can create on your LP position is just a really large amount. So with like a LTV ratio of 95, you're able to generate almost 39x leverage on your LP positions. Very simply, even if you've not made any improvements on the DEX design level, if you can just leverage your LP position 39 times, you can have 39 times more fees that you're earning. And by doing that, Fluid has been able to kind of capture a lot of volume and market share in the pegged asset pools, because that is the only place where you're able to kind of give out these high LTVs for people to borrow and LP into.
Yeah, so the idea is you have like 10K and you want 300K of LP exposure. You just loop it.
The idea is that, and you're fundamentally going to be limited by the liquidity that is there in the Fluid lending markets. So that is one reason why I feel like the design does not scale as much as a lot of these Uniswap P4 hooks might be able to, because you are always going to be limited by the liquidity available in the Fluid pools itself. But it's a really interesting way. Not a lot of teams were unlocking this liquidity that was there in the lending markets and utilize it for providing liquidity on AMMs. This unlock itself is very interesting, and Fluid has taken over Uniswap in a few trading pairs, mainly the pegged asset pairs like wrapped ETH, or wrapped staked ETH and ETH.
Yeah, I do think making LP shares more capital efficient is still something that haven't seen a ton of innovation in. I know there's some money markets that you can do it, and obviously there's some of the isolated stuff where people have been able to borrow against it. But yeah, definitely seeing more innovation there makes sense. I do agree with you though. I don't know how big something like Fluid could get, because there comes a point where you don't want to lend to people doing that, and the returns kind of just cancel out, I guess. Also seems like a pretty tough unwind, but yeah, I don't know.
I think Fluid's pretty interesting as like a lending market. Like, I don't really think it's, as of now, I don't think it's much of a threat to Uniswap. But like I've tried it out. And like the smart debt as like a person like opening up a CDP is like a really nice UX boost. That's like when if I'm borrowing against ETH or wrapped BTC, like I don't care if I'm borrowing USDC or Tether or DAI. And so like, you know, an index of these and make money off people trading them, I think is like a really nice touch. And yeah, I think that's why you're sort of seeing Aave playing nice and going with this alignment proposal with adding the token to their treasury. But with the DEX stuff, yeah, like they're winning on like these three pairs of like correlated pairs. And it's like, if you put these trades into like 1 inch or or like an aggregator that doesn't include fluid, you get the same quote. So it's like, all right, like it's winning volume on these correlated pairs, but it's not like materially better. And then on these like non-correlated volatile asset pairs, there's not as much like lending volume and lending demand for those, or at least not nearly enough to compete with like actual liquidity on DEXs, right? So then you're trying to compete outright for like DEX liquidity on a lending market, which I think doesn't really make that much sense unless like the returns are very high between like so like it's just, you're really trying to create a new type of product if you want to make this a Uniswap competitor. Whereas I think on its own right now, it offers really cool tools for like a lending participant. So in my opinion, I think it's just like, all right, it's an Aave competitor, and like, let's just leave it at that for now. And until like I'm proven otherwise with some of the performance of volatile pairs.
I think what Fluid has unlocked for DeFi is that there is a lot of lending liquidity that can be used in AMMs. And there is a lot of out-of-range liquidity in AMMs that can be just redeposited back into lending markets, which is what Morpho's hook is also about. They're taking a lot of liquidity that is out of range in these Uniswap pools and depositing it into Morpho markets so that it can earn yield even while it's not actively LPing. So I think like the unlock which has come through this is that a lot of underutilized capital in DeFi will be deployed back into AMMs and lending protocols to start earning at least some minimal amount of yield.
Yeah, I think as like my ideal DEX as someone, like what I would want is I want a DEX that's like V2 style, okay, where I can just deposit 2 assets in. I don't want to do concentrated liquidity because I don't want to think about like, you're essentially active market making at that point. I want it to capture LVR, right? So I want to get that money returned to me, and I want the as you said, like out of range assets earning yield at the same time. That kind of feels like the ideal construction for like a retail user to kind of use as this like, you know, you don't want to essentially take you want to just hold 50-50 USDC and ETH, and you always want to hold 50-50. That just like makes you comfortable. You want to sleep well. You also don't want to get fucked by like the LVR, and you don't want these like dead assets sitting there all the time. I think if you can kind of combine all those into a single DEX design, I don't think that you need to like completely remove LVR or to completely make it like the most efficient on like the passive earning yield side. You just need to make it kind of like where the retail user is not getting totally screwed by LPing. And so I do think that's kind of like, that feels like the holy grail to me of how you actually, and like having passive liquidity on chain is just so beneficial to any ecosystem. It's useful for like liquidations, like having all this liquidity on chain, just like people trading. So yeah, I think that's kind of like what I would think the holy grail overall design would be.
I agree with that. The only thing is a lot of these lever mitigation like designs, like you forfeit the fungibility of it, and I don't know, like I think retail LPs on chain, like a lot of them are like kind of degen, right? Like most of them aren't LPing because they think that they're like a professional market maker and they can like make choices and profit, right? They sort of like want to be degens. They want to have like these fungible LP tokens and do stuff with them. So I think if you can partially mitigate LVR like without sacrificing that, I think it'd be a big hit. But I do think like people are excited to use Bunny and like this rehypothecation and like a lot of that stuff, and I think they'll take that over like some basis, like some mark out. I don't think that's the biggest concern to a lot of on-chain LPs.
I personally would be LPing a lot more on-chain if I could have like a passive LP position, but which functions more like an active position and is earning fees in a similar manner as well. I think Bunny and all of these protocols are making like some moves in that direction. Kind of very optimistic about like how all of these hooks play out. And the idea is we'll be seeing a lot of good ideas in every individual implementation. And then it will just be one developer who picks up all of these good ideas and implements it together under like a singular platform and launches it again as a look.
Yeah, no, that's a good point. Okay, so DEXs for next year, LVR with Sorella, these hooks, and like we'll see what people build on top. Definitely feels like, yeah, I don't think there's anything in 24 for DEXs really. So definitely excited to see kind of like where we go from there. And obviously, one of the big themes in the info report was all these like high throughput chains. And so that also just makes a lot of these DEX designs a lot easier when it's, cheaper to do a bunch of stuff. Okay, I want to talk about two more things here. I want to talk about ZKTLS, and then I want to talk about fat wallets. So I think let's start with ZKTLS. Jordan, this is you. You've been talking about this for a while. Maybe first like explain what ZKTLS is and why it's in like the DeFi report and like why it's something to pay attention to.
Yeah, so the simplest way to explain ZKTLS is that if you want to build around or even like access a lot of Web2 data, you need the API key. You basically need their permission to access it. ZKTLS basically lets you ignore that and create a transcript and authentication of your interaction with like a HTTPS server. And so it does that. There's several different ways to do it. There's the proxy model, there's the MPC model, and there's like the T model. But once you have this, you use this zero knowledge proof and you bring it on chain. And so then this lets you sort of like prove that, okay, I just went into my bank account and I saw $10 million there, right? And so I can prove on chain that there's $10 million without showing my entire bank account information, right? And so that opens up a lot of doors with stuff that you can build on chain. And I did a recent report. It was called the Inefficient Market Hypothesis that sort of dove deeper into like how ZKTLS works, and then a lot of the things that people are starting to build with it. It's been like as a concept, it's been explored for like 10 years now. But just now, like in the second half of 2024, it's picked up steam, and you're having like several different options arrive for it. And there's several teams that are building around it now and starting to go live. In 2024, there's going to be a lot of them. And so, yeah, one of the reasons I'm most excited about this is I've been talking about this for a while. Like DeFi needs this sort of consumer DeFi, under-collateralized lending, identity, stuff like that. And people don't really care about it. And ZKTLS is a really easy hack for like Sybil resistance, identity, introducing like alternative collateral types. So like one really good example of this is 3Jane, which is this new lending protocol on Base. And so, yeah, that's going to like let you onboard, like do under collateralized lending by onboarding like soft collateral. So you'll be able to prove through hooking up with Plaid that like you have cash flows and you have like receivables and you have like a job with money, and then, or that like you have a lot of money on Coinbase and stuff like that. So, and then they're doing a lot of like other mechanisms as well, like auctioning off bad debt and stuff like that. But the big unlock is that ZKTLS can allow you to prove arbitrary things in anywhere on the internet, right? And that's a big unlock.
So basically I can prove that I have like this much. I have over, I don't think of the exact number, which is kind of the point, but it can be like I own over this amount in like a brokerage account, or this amount in like a savings account. My credit score is above this number. The last 6 months, I've gotten this average inflow, I guess, of like payments, income. Under-collateralized lending is something that has never been able to work in crypto. This definitely feels like the biggest unlock for that moving forward. Is there anything besides like under-collateralized lending that ZKTLS is being used for?
I mean, so I think it'll be big for like payday loans and earned wage access, because then you can sort of, you can borrow against like your accounts receivable basically. And then you could direct like with consumer DeFi, how you're able to do direct deposit, you could set up direct deposit to like an address or some sort of vault as this middleman, and then borrow against that stream of cash flows. And like, if you're getting really far into the future, like, when ZKTLS isn't so bandwidth limited like it is right now, you could have sort of like ZK location stuff that's like, okay, I'm a family of 4 in the suburbs and I've worked at this job for 5 years, so I'm not going to like pack up my family and leave. So you can sort of like extend more trust to people that you know are just chilling, and that like, all right, this doctor makes $250K and he's not going to uproot his family. He's still working at this job. Like, you can borrow 2 paychecks that as they're flowing into this like, escrow account on chain. Like the possibilities like for this are endless. 3Jane is building this. There's a few other projects that are launching that are building similar type stuff with like payday loans and earned wage access that I think we'll be able to talk about soon. But then, I mentioned a few others. Like there's ZK P2P, which is building like a Ticketmaster competitor that like sits on top of Ticketmaster, because like you have to go into the efficient markets report to like really dive into this. But Ticketmaster is like a monopoly basically. They're getting hit with an antitrust lawsuit. They have a monopoly on like the entire industry, and so they don't. You have to like move tickets on their platform, and that's where like StubHub and all these other like competitors are actually built on top of Ticketmaster. So with ZK P2P, they allow you to prove that you own a ticket on Ticketmaster, and then they facilitate you trading and like setting the price for these with other users, and then it transfers them on the Ticketmaster like app for you. So then you're able to bypass all these like 20% fees and stuff. So yeah, like the thesis with the inefficient markets report is that like every inefficient market out there it exists in some way due to these sort of like regulatory red tape things that exist. And ZKTLS and crypto are like very good match to break these down and allow us to innovate and restore this entrepreneurial spirit to the tech industry and bring consumer apps to crypto.
Yeah, that's cool. I definitely think that ZK in general is going through a bit of a renaissance. We talked about this in the info report. There's just a lot coming. The development has been a lot faster than I think anyone kind of anticipated. So
I would also add to, I mean, this is more, I guess, DeFi adjacent or even kind of deep end related, but it can be very effective for kind of vampire attacking like existing Web2 marketplaces, specifically like service-based marketplaces. So Jordan's the one that actually showed me on this, but Nosh it's sort of like a decentralized DoorDash. DoorDash's take rates right now, I think, Jordan, you'd probably know, but I think they're like upwards of 30-40%. It's ridiculous. And they can do that, right? Because they're a two-sided marketplace with two-sided, network effects. So it's very hard to kind of disrupt that model. Now what ZKTLS allows you to do is effectively take the reputation layer. So a big part of DoorDash's moat is the reputation of existing drivers kind of on the network. And they can effectively allow anyone to prove their reputation. And thus you can onboard them to a more decentralized kind of DoorDash alternative that has a much lower take rate. And this applies not just to DoorDash, but to decentralized Uber or any service-based marketplace where the reputation layer plays like a very key role in kind of insulating these existing Web2 marketplaces. So now it becomes a lot easier to vampire attack them. So I think if there's one killer use case at scale, at least for ZKTLS, I would say it's probably that.
If we also plan to like just rebuild insurance as a sector on chain, I think ZKTLS can have a lot of impact because you're getting verifiable data about each user and you can calculate premiums way more efficiently without users basically lying about any data.
Yeah, that's true. People, like one of the first consumer apps in crypto, people forget about this. It was insurance market, a parametric insurance market called Fizzy. This is back in like 2017. And it had like a fully executing like flight insurance product. And it was basically like you bought insurance, and if your flight was delayed or canceled, then you got paid out automatically like via your credit card, which was like really cool. And this is like one of the major like European like flight people produce this, and they shut it down because it didn't get much usage. But like back in 2017, that was a big theme, was like, oh, hey, look, we're doing this thing with the blockchain, right? But like it worked, it's on chain, you can find it on Ethereum mainnet. But like ZKTLS could bring back like parametric insurance for like arbitrary like events.
I think there were a lot of good like ideas in general in crypto that the tech wasn't there for, and now we kind of have it. So we'll see a lot of these old ideas come back over the next few years, which I'm definitely bullish on. I want to just quickly pivot to one last section. Again, this is something, Robbie, you've written about a lot, fat wallets, fat front ends. You did a whole report on this as well. You wrote about it again here. Like what kind of do you see happening here over the next year in that respect?
Yeah, so I think historically front ends kind of have been written off in this value accrual discussion. And mainly because they've just been seen as like an undifferentiated lens through which you're looking at other applications kind of on the back end. And intuitively, that's a commodity, right? That's not something that's kind of going to capture value. But I think we're kind of seeing this shift. And I think ultimately the way it's going to play out is value is going to accrue to whoever owns what I would describe as sort of the two most important and scarce kind of resources in the crypto economy. One is exclusive order flow, and then the other is distribution. And we could unpack kind of both of them in order. So the first reason is, in terms of exclusive order flow. So I think as we're going to see this MEV supply chain continue to mature, Neil talked about UniV4, we have a lot of these intent-based DEXs that effectively outsource execution to solvers who can source liquidity off-chain. And I think that's a really important nuance. What you're kind of seeing is, I think the natural law here is that at the end of the day, value is going to accrue to whoever is sort of the originator of that order flow. And the reason is actually very simple. It kind of just boils down to competition, right? So if you think anyone downstream of where that order flow originated from has to compete with multiple stakeholders, right? So if you're a searcher, you're competing with other searchers, builders compete with builders, validators, right? And even if you're at that DEX layer, right, you're now competing with all the other UniV4 hooks. You're competing with Uniswap. If you're, in this Solana ecosystem, you're competing with, it's Radium, Orca, and now, you've Camino, who's now launched their own intent-based DEX, which allows them to basically source execution off-chain. Jupiter has their own RFQ intent-based DEX now. So everyone's competing, right? And intuitively, when people are competing, competition always kind of drives down their take rate. Now, the only person in that entire supply chain that doesn't have any competition is the one that actually owns that order flow because, again, intuitively, they have a monopoly on that order flow, right? So I think it's very simple. Like, whoever kind of has less competition has more bargaining power sort of within the MEV supply chain. And therefore, they're the only stakeholder that can actually increase their take rate without losing market share. Whereas everyone else, if a validator increased, their take rate, or if, one of these DEXs increase their take rate, they're going to lose market share, right? So that's why I think it kind of boils down to exclusive order flow in terms of kind of who captures value within the MEV supply chain. And then, the question is, okay, well, who owns exclusive order flow? I think it's becoming increasingly front ends, right? And, that doesn't just mean wallets. I think wallets are best positioned to monetize this, especially given they kind of own the fee insensitive retail user. So MetaMask swaps is like absolutely just printed money over the past few years. And that's because people are lazy, right? They're effectively selling you convenience as a service. So when you just go into your wallet, instead of interfacing with different apps, you can just literally just hit swap kind of right there. So that's kind of why I think, the wallet layer is especially well positioned, but it's also other alternative kind of front ends. And I think especially these, what I would call horizontal front ends that are maybe aggregating different apps across different chains. Infinex is probably the best example of this. I think they're also going to increasingly capture values. Again, they own that sort of exclusive order flow, right? So that's kind of, and again, I think UniV4 exacerbates this trend given, the more hooks you have, the more competition you have at the DEX layer. So I think the market's kind of conceptualized it as like, this is Uniswap's like very noble attempt to solve, LVR as we kind of discussed earlier, right? And they're going to sort of harness the collective hive mind of different developers building these different hooks. And they're going to solve this problem and LPs are going to be profitable again. I think that's probably the wrong take. And it's actually something a lot more strategic. I think the Uniswap team's very, very smart. And I think the way they're kind of seeing this is, they already own that front end. So what they can do, and, Uniswap X is kind of their canonical front end, right? So by creating more competition among all these different projects competing to basically attract that same order flow that Uniswap's front end ultimately owns, in theory, that's going to give better execution to the end user and thus freeing up more room for them to basically charge their own take rate at that front end. So I think one trend, I would say it's non-consensus at this point. I think by the end of 2025, this will be very consensus, is that where you want to be in the stack is the closest to the end user and specifically owning exclusive order flow. So I think downstream implications of that is, one, you're probably going to see more VCs investing, I think, at the front end layer. Multicoins now, they just released their talks from the Multicoin Summit. And Tushar was talking about exactly the same thing, that they're looking to now invest kind of upstream of within the stack. I think also you're going to see more innovation at the front end layer. So you're going to see more, I think, sort of wallets that are more chain abstracted and kind of aggregating different apps. And then I think you're going to see more projects like Infinex kind of pop up as well. So that's kind of the first reason, exclusive order flow. And then real quick, the second reason is kind of on distribution. So again, if you own the end user, you own distribution, you kind of own the attention of the end user, right? And I think downstream of that, you can negotiate some lucrative economics with, other applications and even chains. So I'll give you like one example is, say Berachain wants to kind of bootstrap growth for their ecosystem. They just want to get users kind of on the chain onto some of their applications. If they went to MetaMask and were like, hey, look, if you sponsor transactions kind of on our behalf and sponsor the bridging cost of getting users on chain, and even maybe within your interface, you kind of steer users towards using Berachain, we'll give you some very kind of handsome economics. I think that's definitely realistic. Another thing you've seen is MetaMask has always kind of been exploring this app store vision with snaps. But I think now you're seeing other projects kind of dive into this in a different way. So Backpack's a really interesting example. So they partnered with Dialect, who is the pioneer of this Blinks sort of feature. And now basically they're creating almost like a monolithic user experience akin to like TikTok or X, where users interface not with the applications, but with Blinks kind of within a feed, and creating a very like intuitive, smooth user interface, right? Again, this is possible because they own the end user. Wallets are kind of always been this canonical sort of gateway through which users interface with applications, right? Again, I think some lucrative economics can be kind of negotiated there as well. You're seeing Coinbase Wallet kind of steers users towards specific apps with their like featured apps feature. So, and I think they're probably getting some good economics on that as well. So again, I think it's the way I would describe this is you're going to see kind of the delta between value capture and attention capture sort of erode throughout 2025. And I think the greatest beneficiary is going to be, the interfaces that ultimately own the end user. So I think, again, this is another take that's maybe not as consensus today. But I think you're going to see a lot of interesting features integrated at the wallet layer and just front ends more broadly.
Yeah, I do think stablecoins and front ends are like the two things that you can really extract the most value out of. I agree with a lot of your front end things. I've agreed with this fat wallet thesis. I even wrote fat wallet thesis in like Jan 23 or Feb 23. Haven't really seen it yet, but to your point, a lot of these recent developments, you are starting to see it. When like MetaMask swaps, when that first got popular, I thought that was just people airdrop farming for the most part. But there's really I don't think that's a big portion anymore of people using it. And yeah, like when you're trading these assets that are moving, 50% in a day, you don't care about an 87 bit fee, right? You saw, I forget what some protocol was hacked, and then the hacker used MetaMask swaps, right? And so this is someone that's technically knowledgeable enough to hack a protocol, and they're using MetaMask swaps because, I don't know, maybe they don't want to get rugged on like going to a bad front end or something, right? And they just trust the wallet, and it's stolen money to them anyways, right? So it's like they don't really care about paying a fee. Maybe not the best example, but you have a lot of like fee and sensitivity with these assets just because they move so much.
I was going to add just two things briefly on that. So one is another kind of tailwind for this fat wallet thesis is if you're a centralized exchange and you want to monetize on-chain users, right? So you already own the top of the distribution funnel, you're monetizing those users. Now you want to monetize on-chain users. The wallet layer is like where you're going to do that. And this is why, Jesse, who's initially spearheading Base, is now spearheading the wallet feature for Coinbase. I think that's not a coincidence. I think they really do see the wallet layer is very, very important and a very like monetizable sort of feature. So I think, again, and this applies to OKX, Binance, any major exchange. So I think what they're going to do is increasingly onboard users on chain by doing it through their wallet and then integrating these different features, whether it's kind of in wallet swaps or whether it's native yield on assets or whatever it is. And I think Coinbase is doing that now, where you just basically have USDC in your wallet, you're going to get yield on that. They could clip some fees on that as well. So I think that's also you're going to see a lot more wallets do that. And then the second thing I would add is there's been a lot of talk about chain abstraction. And historically, we've always talked about chain abstraction intuitively at the chain layer and then even at the app layer, like having chain abstracted apps. I think one thing that we're going to see in 2025 is chain abstraction is going to finally get addressed, but it won't be at the chain layer, the app layer, but instead at the wallet layer. And again, that's because you're meeting users where they're at. And so One Balance is a project working on this where they use what's called resource locks. So where they effectively lock your balance on the wallet so that you can't double spend across different chains, and then they can execute whatever your action is on different chains, kind of using intents. So it's actually very elegant, like technically elegant, and also like a very economical solution to chain abstraction. And then Safe, the wallet, is also working on this. And they just released, I forget the name of it, but it's effectively the same exact thing where now you have chain abstracted wallets.
SafeNet.
Yeah, SafeNet, exactly. So I think that's one thing you're going to see is like, we're finally going to have chain abstraction. It's just going to be at the wallet layer where kind of no one else, no one kind of thought it would be.
Right on. Neil, did you want to say something?
Yeah. I actually have like I don't think it's a 2025 take. I think it's a long-term DeFi take for me. I already feel like the take rates that all of these wallets, protocols are taking through all the services that they're providing is already getting quite high. 0.875 is actually quite high if we think about it. I hope over the long term in DeFi, what we see is that we just have like these open source solvers that can do the routing problem for you, potentially maybe embedded within a team that any user can access. So you're using these open source solvers to kind of figure out the routing for you. Basically, a movement towards client-side DeFi, wherein any computation for my transaction that needs to happen can happen on my device. And it figures out the most optimal path for me and can help me execute the transaction at the least take rate possible. So kind of taking back all of that value that we're leaking out to middlemen in DeFi and bringing them back to the users.
Yeah, it's like kind of the long-term point too, I think.
I was going to say that too, though. The fees are ridiculous. Like, Robbie, you mentioned Backpack and Dialect. Like, I saw that little Dialect tweet announcement with them, and like, you just start to wonder, like, Dialect is cool, right? And it's like all of these people are going to have their cut, and there's not room for Backpack to charge an 85 bip fee on top of this. And I know, like, yeah, Solana people are degens and stuff, but other people are taking that fee too. Like MetaMask charges the 85 bip fee, and MetaMask isn't adding the value that Backpack and Phantom are, right? Phantom and Backpack are adding value because Solana mobile is very poor, right? Whereas MetaMask mobile is terrible, and they still charge you that 85 bip fee. I am concerned about it. There being like way too much value capture from the wallets, and then they're still integrating all these other services that are also adding value, and they're going to need their cut too.
Yeah, I mean, I definitely agree. Like, these are very high fees, but I think they can be justified, right? Like, people are paying for it. It's capitalism, right? At the end of the day, and I don't think it's just about adding value. I think it's about being in a position where you can actually, extract value, right? If you're looking at purely through the lens of, like, if I'm looking at this through the lens of an investor, then, MetaMask, incredible business. Obviously, as a user, this is not what you want to see. So I think it's important to, I guess, distinguish between the two of those. But I think, yeah, these teams, they're smart, right? And I think that's why you're seeing them successfully kind of extracting this value. Obviously, over the long run, I'd like to see, again, this is why I kind of got into crypto. I imagine it's why a lot of you guys got into crypto. We're here to kind of disintermediate, middlemen, right? And kind of return this value back to the end user. So I agree, this is a little bit antithetical to kind of what we came here to build. That said, these are very, very good businesses that own distribution, and therefore they can kind of charge what they charge.
I don't know if it's totally antithetical. Crypto is also just like hyper-capitalism. Crypto has like this weird mix of very socialist vibes and also very capitalistic vibes. I think the wallet thing, though, is kind of, a good example of it. But yeah, anyways, for people listening to this, obviously we couldn't these were the main themes in the report, but the podcast can't really do it justice. We got nice, pretty charts, and the DeFi team makes some nice, pretty charts that makes everything kind of easier to digest and understand. A lot more deep dives in all these sectors. So definitely go ahead and check that out. I found the stuff interesting. And the last one coming out here will be the DPIN DEAI one, which two newer sectors. That's actually the first year we're doing reports for these sectors. So that'll be excited. I know everyone's pretty hyped up on the agent stuff right now. So yeah, with that being said, thank you to Jordan, Neil, and Robbie for not only the report but also coming on the pod. And have a good rest of the week and good holidays.